Okay, let's get through chapter 15. I know we love this finance stuff. F. Well, good. That's good. That is a good sign. Um, just FYI, um, chapter 17 is coming up, and chapter 17 is the valuation chapter. I don't think it's the hardest chapter at all, but it is one of the most math-centered chapters. I mean, almost everything in the remainder of the class is math-centered, but chapter 17 is specifically that way. So I would highly encourage you, before we get to chapter 17, if you haven't, watch videos about it, read the chapter, so that when we start working through all the math that's involved, you'll be good to go. That will be Wednesday. Wednesday.
Now, are you doing 17?
Yeah.
On Wednesday?
No, I mean,
Yeah.
you.
Me, as in me? Yes, me. Yes, that is the game plan. Yes, that is the game plan.
What you for the hardest chapter?
Yeah, chapter 17 is a lot of math. I don't think it's hard. I think it's math centered, because it's valuation, and valuation's always a math question, right? What is something worth? That's a number, and so that's that's where we're going. But for right now, let's finish up the financing idea, and which is chapter 15 in the new alignment of the book. I have to change these slides. So chapter 15 is all about the differences between the primary and secondary mortgage markets. There are a lot of differences that we spend a lot of time on, but this one is a very simple one. The primary mortgage market is where loans are made. So everything that we've been talking about to this point about financing, notice that we've been talking about singular loans. The secondary mortgage market is not about where loans are made. The secondary mortgage market is where loans are bought and sold. They're packaged together in big buckets of hundreds, if not thousands, of loans at a time, and they're sold to investors. And so there's going to be some material that you need to know about the secondary mortgage market, and that's what we're going to talk about. The first thing they bring up to you is the Federal Reserve System, and I'm going to go through a lot of these slides real quickly because there are, quite honestly, much more detail here than you really need, and I'm going to filter down what you really should pay attention to. The Federal Reserve System, all you need to know about it is that it is the money manager for the country. The Federal Reserve System controls the flow of money in this country. It's basically there to maintain the flow of money, and they do that through control of interest rates. Interest rates control the flow of money. Lower interest rates lead to money flowing more rapidly, and higher interest rates slow down the flow of money. And the Federal Reserve System is there to basically create a positive system to control inflation and deflation and create positive environment for the economy. And this just gives you an idea of where the different Federal Reserve districts are located, but you don't need to know any of that, obviously. One of the things that the Federal Reserve does do is control what's called the discount rate. The discount rate is just the rate that money, the rate at which money can be borrowed from the federal government, or that banks can charge each other for loans. All right, and obviously that flows through to everything else. So when you hear on the news that the Federal Reserve is considering raising interest rates, the Federal Reserve doesn't set mortgage rates. They don't set car loan interest rates or credit card interest rates. The rate they set is this discount rate. But that rate impacts every other interest rate, because if the banks have to pay more money to borrow money themselves, guess what they do with the rates they charge consumers for all different kinds of loans? They raise their rates on all those loans. So that's why that rate filters through to everything. Now the Treasury is our bank, essentially. This is the nation's bank and controls all of the banks in the country, and also controls the FDIC, which we've talked about previously, which stands for the Federal Deposit Insurance Corporation. The FDIC is controlled through the Treasury. Treasury also manages our debt as a country. There are lots of sources of money in the primary mortgage market. The big thing you need to understand about the primary mortgage market, though, is it is where loans are what? Made. So, I walk into a bank and I get a mortgage loan. That is a primary lending function. Primary lending is where the borrower borrows the money. Secondary is where the loan, the note, is being sold to a different investor. Does everybody follow that? So the primary mortgage market is where the borrower is. The secondary mortgage market is where the notes are being sold to these different investors. Okay? So there are lots of sources for the money in the primary mortgage market. You don't need to memorize any of these. That's why I'm just skipping through them quickly. You just need to understand that the primary mortgage market is funded by all sorts of things. Like, for example, one of the primary sources of money in the primary market, I shouldn't say the word primary so many times. One of the big sources of money in the primary market is from insurance companies. Well, where would insurance companies get money to fund mortgages? From the premiums paid to them. That's why when there is a breakdown in the mortgage industry, there's also a ripple through lots of other industries, because lots of other industries invest their money in mortgages. Credit unions, banks, pension funds, investment funds, retirement funds, endowment funds like universities and hospitals have. All those places are sources of money in the primary lending market. We call these people either mortgage brokers or mortgage bankers. The difference between a mortgage banker and a mortgage broker is a mortgage banker works directly for a bank. So they can only lend you money from that one bank. Whereas a mortgage broker can lend you money from multiple sources. They can shop around and lend money from multiple sources. They don't work for any one lender in particular.
It says primary insurance.
Yeah, it should be primary mortgage market. Yep. Thank you. Thank you. So, the secondary mortgage market, which is really what we want to talk about in this chapter. The secondary mortgage market is where these loans get sold. And the reason for that is to replenish the money. If you remember, we talked about this a little bit last Friday, and we said that the problem that the bank has, if they only have $1 million to lend out and they make 5 loans, is that they're now what? They're out of money. They can't make any more loans. So the secondary mortgage market is a way for them to quickly, efficiently sell those loans, get that money back in so that they can do what with it again? Loan it out again, make more loans. That is the function of the secondary mortgage market. So we're going to talk about a lot of things in the secondary mortgage market, but I'm going to turn the slides off for a second because I want to make you I want to kind of give you the storybook version of this because I think it will help you a lot with making sense of these different things rather than trying to memorize them. You try to memorize them, you're never going to make sense, heads or tails of any of it. So in the secondary mortgage market, if Sean has $10 million that he wants to invest, and he wants to invest it in mortgages, but he doesn't have the ability to really meet borrowers and evaluate borrowers and decide if they're a good credit risk. He needs a way to be able to buy those mortgages. Does that make sense for everybody? So one of the major problems that came out of the Great Depression, so almost all these solutions that we talk about were begun during the Great Depression. One of the major problems that came out of the Great Depression was the inability of banks to sell their mortgages. Because what happened, the banks had all this debt that they were owed, and when the stock market collapsed and people went to the banks and started trying to draw money out, the banks didn't have the money to give people. And why didn't they have the money to give people?
People weren't buying their loans, so they could turn it around.
Right. They had loaned that money out. That's where money comes from for banks to make loans, is the deposits, right? So they couldn't give everybody their money back because the money had been loaned out. And they didn't have any way to get that money back because they didn't have the ability to sell the loans. So one of the major solutions was Congress decided that we needed a system which would in some ways guarantee that there would always be a way for these banks to sell their mortgages so that they could get that money back in the door when they needed it. And one of the big problems in the Great Depression was not only that the banks couldn't sell their loans, people couldn't get loans because the banks didn't have money to lend. Does that make sense? And that's how an economic downturn turns into a depression and takes 20 years to unravel, because there's no way to get traction, to get things back moving. There is no money to lend because the banks can't sell the loans to get any more money in the door. It's a nasty cycle. Does everybody follow that? So, something called Fannie Mae was created. Now, Fannie Mae is a private company. It actually is not called Fannie Mae. It's FNMA, the Federal National Mortgage Association. You don't need to memorize that at all, I promise. Okay? The Federal National Mortgage Association, Fannie Mae, was created, and it was created as a private company. What's the job of every private company? To do what?
Make money.
Make money. That's Fannie Mae's job too. So, now, we go back to Sean with his $10 million. Here's what Fannie Mae was designed to do. Sean doesn't need to find mortgages to buy. What he needs to do is buy stock in Fannie Mae. Fannie Mae is a company. Companies have stock, right? It's a corporation, has shareholders. So if Sean invests his $10 million in Fannie Mae stock, guess what Fannie Mae is going to do with that $10 million? They're going to buy loans. And then in turn, the lenders, the banks, are going to make more loans. Because if Fannie Mae has $10 million, they can go to SunTrust or Bank of America or BB&T or whomever and buy $10 million worth of mortgages. Does that make sense for everybody? Are we good with that? Now, how does Sean make money as an investor? He's going to get dividends back from the interest. He's going to make money off the interest. And what else? How else do you make money in the stock market? This is stock. Right. If the company does well, what's going to happen to the stock price? It's going to go up. So his investment in Fannie Mae has the potential to not only bring him revenue in the form of those interest payments, but can the stock go up in value and his investment increase in value? And presumably, what would make Fannie Mae's stock go up in value if they buy what kind of loans?
The conventionals.
Well, but why? What's great about what kind of loans would, if you were investing in a company and they were using your money to buy loans, what kind of loans would you want them to buy? Ones that are really risky or ones that are going to be really safe? Safe. You want them to buy the loans that they made to the people who are going to pay them back, right? And that's exactly what Fannie Mae did. Did it well. Now, here's the only catch about Fannie Mae, but it's a big one. It's a whopper. Because of the Great Depression, the question was asked, what if there are no investors? Because what triggered the Great Depression was the stock market collapse. Fannie Mae's stock could collapse just like anybody else's. And if Fannie Mae's stock is collapsing and nobody's buying Fannie Mae's stock, does Fannie Mae have any money to buy these loans with? No. So, here's what the United States Congress did. They gave Fannie Mae a blank check. They gave Fannie Mae a direct line to the U.S. Treasury where Fannie Mae could borrow money. It is the only private company in the world that can borrow money directly from the United States Treasury. And it was specifically designed that way so that when private investment went away, Fannie Mae still had a funding source. Because if Fannie Mae could continue to borrow money from the federal government, even when the market went bad, then they could continue to buy what? Loans. And if Fannie Mae's buying loans, what are the banks doing?
Lending.
They're lending. And if the banks are lending, is that not moving the economy? Remember what this whole thing was created to prevent. The whole thing was created to prevent this situation where nobody could do anything, right? Where everything was frozen. So that was the solution. Is that making sense so far? Okay. Now, it's not designed for Fannie Mae to borrow money all the time from the federal government. It's only designed to do that in times of disaster. All right? Are we with me? What was the purpose of Fannie Mae, though, from Sean's perspective? Make money, right? So he doesn't want Fannie Mae borrowing money from the federal government, because if Fannie Mae's borrowing money from the federal government, then his investment looks like crap, right? Because the only reason Fannie Mae would be borrowing money from the federal government is if nobody else is investing in Fannie Mae because their stock is plummeting. Does everybody follow that? So Sean wants Fannie Mae to buy really good loans. Really good loans equal conventional loans. You can put that in your notes. You can put it in your brain. In fact, you better put it in your brain, because you need to understand that. A conventional loan is a really good loan. Now, we're going to give you another definition here in just a few minutes, but for right now, you need to understand that conventional loans are loans made to the best borrowers. These are loans made to people who have really good incomes and really good credit histories, and they are making a sizable down payment, which means their loan-to-value ratios are what? Low. That's right. A low loan-to-value ratio equals a higher down payment, right? They're sort of opposites of each other. The lower your down payment is, the higher your loan-to-value ratio is. Is everybody okay with that? So, here's the problem with that, at least from the federal government's perspective. The federal government had created several types of loans called government-backed loans. FHA loans, VA loans, USDA loans. The government created all of these loans to try to benefit certain groups of people, like the VA loan. The VA loan was created specifically to benefit veterans of World War II. They wanted them to have the ability to buy a home. And in the case of the VA loan, they said we wanted them to have the ability to buy a home so bad that we would let them borrow 100% loan to value. Does that make sense for everybody? 100% loan to value. Now, look at that from Fannie Mae's perspective. Forget that. Look at it from from Sean's perspective. Look at it from Sean's perspective. He's investing his money in this company. And now they want to go out and buy loans that are made to a bunch of people that put how much money down? Nothing. What does he say about that? No way. Isn't that what you would say? Don't buy that crap. Right? So if Fannie Mae won't buy a VA loan, how many banks are going to make them? None. That's exactly right. None. Because now, at that point in time, the banks had transitioned to a system of primarily writing loans so that they could do what with them? Sell them. And if you can't sell it, it's like owning a bakery and you make the same donut 10 days in a row and nobody buys it and you keep making it. What are you going to eventually stop doing? You're not going to make that donut anymore. And that's what happens with VA loans and FHA loans. If Fannie Mae won't buy them, then nobody makes them, because the banks don't want them. They only want to make loans they can sell. Are you with me so far? Now enter Ginnie Mae. Ginnie Mae was supposed to be the solution to that problem. Ginnie Mae's job? Buy the crap. Buy the crap. The stuff that Fannie Mae would not touch with a 10-foot pole. So what makes a loan bad from Fannie Mae's perspective that they'd be afraid to buy it? 100%. High loan to value. What else?
Probably people with like lower credit.
Bad credit.
Bad income. Not bad income.
Lower income. Aren't all those things that would scare you about a borrower if you were making them a loan? Absolutely. So you know what Ginnie Mae was created to do? Buy that loan. Buy that loan. Because guess what that loan is? That's an FHA loan. That's a VA loan. That's a USDA loan. See, Ginnie Mae was never meant to make money. Ginnie Mae is the federal government. Because here's what Ginnie Mae does. Not only does it buy the crap, how could somebody take something that you were completely... How many of you have ever looked at like a used car? Right? Were you scared to buy it?
Oh, yeah.
Why?
You know what had happened to it before?
You don't have any idea, right? It's scary what could happen, right? You think it's a good chance it could break down. Everybody been there? You know what I'm talking about, right? What would make you feel better about buying that used car? Learning the history, or what else? Get a warranty. If the person selling it to you is willing to guarantee it, right? Especially if you really trust the person selling it to you, right? Who did I say Ginnie Mae was? The federal government. Ginnie Mae's not going to hold these loans for long, folks. Ginnie Mae buys that loan just long enough to put a guarantee on it. And that guarantee's coming from who? The United States federal government. The full faith and credit of the United States federal government. And then they offer that loan up for sale to guess who? Who buys the loans? Fannie Mae. Fannie Mae, who didn't want that VA loan 5 minutes ago because it was high loan to value and high risk. Is it still high loan to value? Is it still high risk? Yes, but who has the risk now? The federal government, because they bought it through Ginnie Mae, they put a guarantee on it, and then they sold it to Fannie Mae. Now, is Fannie Mae interested in buying now with a government guarantee stamped on the back of that thing? All day. In fact, they just as soon have that as a conventional loan. Because now that loan is guaranteed by the United States federal government. Does that make sense, guys? See, that's why I give you the storybook version, because when you can think of it in those regards, you understand what the process looks like. So basically, if I ask you this question, conventional loans, who's going to buy them? Fannie Mae. Government-backed loans, who's going to buy them? Ginnie Mae, then Fannie Mae. So who ends up with them all eventually? Fannie Mae. If you can answer those 3 questions, that's all you need to know about Fannie Mae, Ginnie Mae, and it took them 72 pages to say that in the book. Really. That's it. That's it. That is the whole process right there. So Fannie Mae can borrow money directly from the U.S. Treasury. And Ginnie Mae buys those government-backed loans and then reissues them. Sells them to Fannie Mae with the guarantee stuck on the back of them. We're not going to talk about Freddie Mac because he died during the crisis. All right?
So Freddie Mac is no more?
You don't have to worry about it. You don't have to worry about Freddie Mac. So let's talk about the 2 major categories of loans. Conventional and government-backed. And we sort of just talked about them already now. A conventional loan. The number 1 definition, put it in your notes, of a conventional loan. The defining characteristic. The one thing that screams conventional loan. Not government-backed. That's what they'll put on the test, and people will answer 72 other different things before they'll get to the main thing. It's not backed by the government. That's what makes it conventional. It might have mortgage insurance. And what is mortgage insurance? It's insurance against what? Default, right? It's insurance that if the loan defaults, the insurance company will pay the lender so that they don't take a loss. That's what mortgage insurance is. And conventional loans could still have mortgage insurance. It would just be private mortgage insurance. But the key feature about a conventional loan is that it's not government-backed. Now, generally speaking, there are other things that make it desirable. So let's quickly look at a picture here, because I think a picture sometimes, wrong one. I think a picture sometimes is worth 1,000 words. If we think of a loan as sort of a bucket here, most conventional loans will let you borrow up to 80% LTV. 80% LTV is considered not risky. So if you have a loan where somebody comes along and this is what they want to borrow, you generally consider that to be not risky. And that's going to be called, in most cases, a conventional loan. If I could spell. A conventional loan, which means there's no backing from who? The government. Now, the rest of this bucket here, the top 20%, presumably, where's that money coming from? The buyer as what? Down payment, which is also equity. This is our down payment up here. And the reason this loan is considered not risky, think about the collateral involved in a mortgage. What's the collateral? The property. And the guarantee that the lender is going to get their money back is that if they had to foreclose, they could sell the property and get all their money, correct? Well, think about it. If I'm only lending 80% of the value, isn't there a very good chance that if I had to foreclose, I could sell it for at least enough to get my money out of it? Yep. This is why this is considered a safe loan. And that number is important. That 80% loan to value, it's still so important today. The reality, though, is that even in conventional loans, borrowers may not have a 20% down payment. They might find themselves somewhere like this. Maybe they're at 90% LTV. Well, what happened to our down payment? It got cut in half. And what made up the slack? Not necessarily even a second mortgage, but just a mortgage, right? Could they lend 90% loan to value instead of 80% loan to value?
Do that?
Sure. Could they even go, I don't know, all the way up to like here?
They just charge a higher interest rate.
95% loan to value. Could we get up there? Yeah, sure. Go anywhere we want to go. Now let me ask you a question. The thing that made this not risky was that we could foreclose on the property and very likely do what? Recoup our money if we had to sell the property. Does that get a little bit dicier here at 90%? Does it get more dicey up here at 95%? So what is happening to the lender's risk as we go up that chart and that down payment gets smaller and smaller and smaller? The risk is getting bigger and bigger and bigger, right? So a couple things happen when risk gets greater. I heard somebody say interest rates would go up. Absolutely, in most cases they would, right? Generally speaking, higher risk is going to relate to a higher interest rate. Does that make sense? Another thing happens here, though. Mortgage insurance. The lender is not going to be comfortable with this setup. The lender is going to be deathly afraid that if they foreclose, there's not going to be enough money to cover the amount of money they've outlaid. Does that make sense for everybody? Are we good with that? So what do you do when you worry that you might have an unexpected expense that you can't afford? You buy what? Insurance. That's what mortgage insurance is. Mortgage insurance is insurance that if this borrower defaults and we foreclose on the property and we sell it and we don't get all of our money, the insurance company is going to do what? Give us the rest. They're going to cover the loss. That's what mortgage insurance is. The interesting thing about mortgage insurance, though, is this. Who's it cover? The lender. Who's going to pay for it? The borrower is. And the reason it works that way is because the lender says the only way I'll lend you this much money is if you buy mortgage insurance to cover me. Now let me ask you this question. Looking at this chart, is the mortgage insurance going to cover the entirety of the loan? No, because up to here we didn't even need mortgage insurance, right? When we buy mortgage insurance, we're only covering the amount of the loan that exceeds 80% loan to value. So if we made that 90% loan to value loan and the borrower defaulted and the lender sold the property and didn't get all their money back, how much of the loan would be covered by the mortgage insurance?
The difference between the loan to value and the
90%. The difference between 80 and 90, right? So that 10% gap. Does that make sense for everybody? That's what mortgage insurance does. That's the idea of mortgage insurance. Are we okay on this basic concept? Are everybody okay with that? You good? Okay. All right. So that's why mortgage insurance exists. And it exists quite often in today's world because we do a lot of high loan to value loans. Now, generally speaking, a conventional mortgage loan is going to be characterized by lower loan to value ratios. Ideally, what percent or lower? 80% or lower, ideally. Okay? And usually also by better quality borrowers. Now, if we do end up, let me skip over that. I don't need that. If we do end up above that 80% loan to value ratio, then we buy something called private mortgage insurance. With private mortgage insurance on this slide, I want you to put conventional. Because private mortgage insurance is the type of insurance you get on a conventional loan. Remember what was the definition of conventional? Not what? Not government-backed. A conventional loan is a not government-backed loan. So the insurance you get on a conventional loan, and you would only need insurance if you borrowed more than what? 80% loan to value. So if you're getting a conventional loan and you're borrowing more than 80% loan to value, you're going to get a private mortgage insurance policy.
Isn't that where that like 8 number comes from? From earlier, like after 8 years, you no longer need mortgage insurance because you covered 20% of the loan.
It depends on how, what your loan to value is. It could be. Could be. But you bring up a really good point. The private mortgage insurance will go away at some point. Remember, if you were putting at least 20% down, you wouldn't have had to get mortgage insurance in the first place, right? So, when you get a conventional loan with private mortgage insurance, once you get more than 20% equity in the property, then the mortgage insurance is going to go away. Does that make sense for everybody? It goes away. You're not insuring anything anymore, so it goes away. Now, let's talk about the government-backed loans. FHA. The FHA, first of all, let me clarify something. We'll make a general across-the-board statement. The United States government does not make mortgage loans. None of these government-backed loans that we're going to talk about are made by the federal government. Not one single one of them is made by the federal government. They are government-backed. What does backing mean? They insure them. So if I ask you, do government-backed loans have mortgage insurance, what would your answer be? Yeah. Who's the insurance come from? The federal government. So it's not private mortgage insurance, it's government mortgage insurance. It's still just mortgage insurance. And oh, by the way, it ain't free. As a matter of fact, it's far more expensive than private mortgage insurance. The federal government makes a ton of money on these loan programs, folks. They are the world's biggest mortgage insurer. And you pay premiums to them for this mortgage insurance just like you do for private mortgage insurance. The only difference here is who you're getting the mortgage insurance from. So if you're getting private mortgage insurance, what kind of loan do you have? A conventional. If you're paying Uncle Sam for the mortgage insurance, what kind of loan do you have? A government-backed loan. That's exactly right. So these are the government-backed loan programs. These are all signified by one thing: high loan-to-value ratios, very high loan-to-value ratios. This first one is actually the lowest loan-to-value ratio of the government-backed loans. The FHA loans. Anybody know what the loan-to-value ratio is on an FHA loan? 97. 97% loan-to-value. So that means what sort of a down payment would you need to purchase a house using a FHA loan? 3% down payment. Is that risky from the lender's standpoint? Yes. You're going to need mortgage insurance. And the only place that will sell you the mortgage insurance on that kind of a risk is the federal government. That's why this is a government-backed loan. Okay? But FHA doesn't lend money. FHA doesn't set interest rates. FHA does not set lending rules. FHA is just the mortgage insurance. That's it. Who sets the interest rates? The lender does. The bank does. It's just like any... Can you have more than one FHA loan? Sure. You can have more than... You can have more than one of these at a time.
Is there something you have to qualify to get these?
Everybody qualifies for FHA as long as you have minimum credit score and income requirements. The current minimum for an automated approval with FHA is a 620 credit score. That is the current minimum. That's for an automated. You can get a manual approval lower than that, depending on your income situation. But the minimum for an automated approval is a 620.
But the interest rate will be substantially higher.
It will not. It will not. These are extremely competitive interest rates.
What's the trick?
The insurance.
Okay.
The insurance is expensive as all get out. That mortgage insurance policy that you're paying who for, by the way? The federal government, is expensive. And remember when we talked about the fact, Rachel asked about private mortgage insurance going away when I had paid the loan balance down? Guess what? This never goes away. If you keep this loan for 30 years and you're 29, you'll still be paying mortgage insurance on it. FHA mortgage insurance never goes away. And currently, to give you an idea of just how expensive it is, it's 150 basis points, which equates to 1.5% of the loan amount annually. So, on a $200,000 loan, that's $3,000 a year in mortgage insurance. That doesn't count the interest. These are expensive. Your client should never get a government-backed loan unless they can't. Think about how we talked about installment land contracts. People say, why would anybody do that? What's the answer? Because they can't what? They can't do it any other way. Why would somebody get an FHA loan? Because they can't do it any other way. People should always look at conventional first, because conventional is always going to be a better deal. Less fees, cheaper mortgage insurance if you have to have it. But if you don't have a down payment, this is the route that's available. Yes, Celine. Yes, because Celine's question is it better? Is it a better deal even if I'm paying PMI? The answer is yes, because PMI is cheaper than the government version of mortgage insurance. They both have mortgage insurance, and the PMI could potentially go away. I'm sorry? That's right. So that's the borrower who should focus on an FHA loan, the one who does not have the down payment. And there are other reasons. If I don't have good credit, maybe I've got the down payment, but I don't have the credit, I may still end up in an FHA loan because I may be too risky for a conventional lender. Has everybody got that? Okay. Remember, FHA does not make loans. Who makes the loans? The banks do. And who's going to end up buying these loans? Fannie Mae, ultimately, after Ginnie Mae buys it and then guarantees it and then sells it to Fannie Mae.
Isn't this, don't you have to make like a certain
That's the USDA loan. That's the USDA. We're getting there. Okay. Yes. United States Department of Agriculture. Yes. Okay. All right. Let's talk about general characteristics of the FHA loan. No prepayment penalty. That's a law. Fully assumable.
Well, that's a reason to do it right now.
It's a reason to get one so that down the road it could be assumed, potentially. So fully assumable, high loan to value, no prepayment penalties. Those are the things I'd say you need to key on. Okay? And remember, the interest rates are not set by FHA, they're set by the lenders themselves.
What was the third one? Fully assumable,
High loan to value
No payment.
and no prepayment penalties. VA loans. The VA loan program. VA stands for Veterans Administration. So what kind of loans, what kind of people you think qualify for these loans? Veterans. Yep, it's technically veterans and their qualifying spouses, but as long as you remember veterans, you'll be in good shape. So, I have to be a veteran in order to qualify for a VA loan. FHA loans were pretty high loan to value, right? What was that loan to value ratio? 97%. Now, if I'm a veteran, can I get an FHA loan? Sure I can. So then why have another loan program? There must be some bonus here. There must be something that's better about the VA loan. It's 100% loan to value. That's the difference between the FHA loan program and the VA loan program. Other than that, folks, they're pretty much the same loan.
Still paying that high insurance.
Still paying that high mortgage insurance. The only difference with the VA loan is it truly will let you do it with no money out of pocket, because not only can you borrow 100% loan to value, you can actually roll your closing costs in to the loan amount with a VA loan. So you can actually borrow more than 100% loan to value. So the VA allows you to pay your mortgage insurance in one lump sum rather than monthly. So you can, it's a few $1,000s, you know, several $1,000s, but you can roll it into the loan. So you can do it, sign and drive. That's it. And just you $0 out of pocket on a VA loan. That's the idea behind the VA loan. Huh? I said something about 50,000. Did I say something about 50,000? Oh, okay.
Was that like you said the mortgage insurance you could pay in one month?
Yeah, so with a VA loan, and you don't need to know this for the test, but with a VA loan, the mortgage insurance doesn't have to be paid monthly. It can be paid once up front. It's called a funding fee. And VA will actually allow you to roll that into the loan amount. So let's say I was buying a $100,000 house. Not only could I borrow the full $100,000, but say my funding fee was another $4,000 or $3,000, I could actually borrow $103,000 and roll. So now I've rolled the whole thing in. I'm not written any check out of my pocket. That's the advantage of the VA loan program. Now, who do you have to be to get one of these loans? A veteran. Who do you have to be to assume one of these loans? Anybody. Anybody can assume a VA loan. Now, it does get a little bit dicey there, though. The veteran whose loan you have assumed can't go out and get another VA loan until you've paid theirs off, because each veteran has an entitlement to a VA loan. If they allow you to assume their loan, their entitlement's still tied up in that loan. So until that loan's paid off, they don't get their entitlement back. Does that make sense for everybody? So basically, if I'm a veteran and I take out a VA loan and I sell my house and I pay the loan off, I can go get a new VA loan because I got my entitlement back because that loan's been paid off. But if I sell Rachel my house and Rachel assumes my VA loan and I go apply for another VA loan, they're going to say, no, you've already got one, because my entitlement is still tied up in that one I allowed Rachel to assume. Make sense? Everybody good with that? So anybody can assume a VA. Again, fully assumable loans, no prepayment penalties. All the same rules apply to VA that apply to FHA. Unlimited assumption. Should say unlimited assumption, not allowed. Unlimited assumption was prior to 1988, you didn't even have to qualify to assume one. They didn't even check your qualifications. Okay? You don't need to know these different FHA loan programs. They're listed in your slides here just so you know that there are several different types, but you don't have to remember them at all. You don't need to know what the 203B program is. You don't have to remember any of that. The last of the government-backed loans is the United States Department of Agriculture. Doesn't it sound like they'd be in the real estate market? They don't have enough to do in inspecting your beef. They need to also make some home loans, apparently. USDA does have a loan program. It's called the Rural Development Loan Program. It is designed to target rural areas so that there's always a flow of lending in those areas. And this one was the one I presume you were asking about earlier, Rachel, because this one does have maximum income. You have to make at least this amount, but you can't make more than this amount. Right, household income. Right, household income. Yep. USDA loans. What's the benefit of the USDA loan? Why not just get an FHA loan? Because FHA loans work everywhere. Why not just get again, 100% loan to value. So the USDA loan will be something to look at for somebody who didn't have a down payment, wasn't a veteran, and was only interested in living in a what? Rural community. Now we're getting it narrowed down pretty damn tight now, aren't we? Remember I said these government-backed loans are kind of last chance saloon anyway. And it's not that they're bad. There's nothing wrong with them. I'm just saying because they're expensive, because they're fee heavy, you should always look at other alternatives first. But if somebody doesn't qualify for a conventional loan, and then you look at it and say, okay, well, maybe we should do FHA. And they say, well, I don't have the 3% to put down. Well, we're pretty much left with VA or USDA, right? And they say, well, I'm not a veteran. And that leaves us with USDA. And they say, well, I want to buy a house in Raleigh. You say, wrong.
Move to the country.
Because USDA is not going to lend in Raleigh. What kind of loan is this? A rural development loan. So you're going to have to find an area that qualifies for this kind of a loan. So, and it's based on censuses. You can actually go to the USDA website and put in an address, and it will tell you whether it's in a USDA qualified area or not, because this is limited by area. And it'll be updated again at the next census.
It has to be under a certain amount.
Yes, there's limitations on it. It's a pretty limited loan. But I will tell you, there's some pretty interesting programs you can do with it. I closed one last year, USDA loan, so it's 100% loan to value. The seller paid their closing costs. We applied for something called a mortgage credit certificate, which basically gives them an advanced tax credit in the amount equal to the interest they pay on the house, which they're allowed to use as a monthly voucher, which offsets the payment. So they brought no money to the table, and their house payment on like a $200,000 house is like $742 a month. It was just, I walked away from that closing going, oh my God, like I'm doing the wrong thing, I'm on the wrong side of the table here or something. So there's some really interesting things that can be done with those loan programs. Okay, so with USDA, it doesn't have to be a certain type of property, but it has to be in a qualified area. They have some rules about mobile homes. Manufactured homes always bring in certain rules. It's really going to depend on, has it been converted to real property, has it not been converted, that sort of thing. All right, so let's talk about a couple of these special types of mortgages or loans here. You don't need to know all of these, but you do need to know this top one. A purchase money mortgage. This is seller financing. A purchase money mortgage is seller financing. We've talked a little bit about seller financing. What did we say was happening when we had seller financing?
They're retaining the deed.
No,
Paying off.
that's an installment land contract. What's seller financing? What is financing? When I do what? What is any kind of financing? Don't make it overcomplicated. What is financing?
Lending money for
Borrow money to do what? To purchase with. Seller financing is the same thing. Just who am I borrowing the money from? From the seller. Am I still purchasing the property? Yes. Is title going to be transferred to me? Yes. It works just like any other transaction, except who do I now owe the money to? The seller. That is seller financing, also known as a purchase money mortgage. Another phrase that you would look for. Oops, I can't write with a highlighter. Get out of there. Seller takes back a note. That is seller financing. How does it work when you borrow money from a bank?
They actually give the buyer money, or they just
How does it work when you borrow money from a bank?
sign a promissory note
Sign a promissory note and what? What other document do you sign that gives collateral? Well, in a lien theory state, it would in the title theory state like North Carolina, it'd be a deed of trust. That's exactly how seller financing works. The seller gives the buyer money. The buyer signs a promissory note.
So the seller actually gives the buyer money.
Does the bank actually give you money at a closing when you're buying a house? It works just like, so you're trying to differentiate it, but it's not different. It works just like a normal purchase does.
Is there insurance, mortgage insurance on this amount?
Most of the time there's not mortgage insurance. I mean, there is going to be a trustee to hold the deed. It works just like any other mortgage loan. See, we try to make it complex because it's foreign, right? I never heard of that. It's the same thing.
Seems awfully risky.
It is risky, so why would a seller do such a thing? Don't have a choice. I can't find another buyer.
Or maybe there's like a ridiculously high interest rate that they set.
Maybe there's got to be something to incentivize them to do it. But it works, to Celine's question, it works just like, no different from, absolutely just like any other finance situation. There's not a thing in the world different about it. Sean is buying a house from Ashley. He agrees to pay Ashley $100,000. He's getting an 80% loan-to-value loan. Who's the 80% coming from? From Ashley. So, how much would he normally make as a down payment if he was paying $100,000 and he was getting an 80% loan-to-value loan? $20,000, right? Guess what down payment he's still going to make? $20,000. But when they walk away from that closing, who's going to have title? Sean is. And what is Ashley going to have? $20,000 and a note that Sean owes her what? $80,000.
I see my confusion. I'm thinking the bank is actually paying the seller of a home.
Well, they're paying it into the closing.
Right, they're paying the seller purchase price they asked for.
Right.
That's the difference. Here it's just selling the buyer, signing the note.
I still owe you this much money. That's exactly right. That's why we say seller takes back a note, because they're not getting the whole purchase price. They're getting that, plus they're getting a note. Does that make sense? Okay? So that's seller financing. On that slide, I would say the purchase money mortgage is about the only... Oh, crap. I didn't mean to do that. I hit the wrong button. The purchase money mortgage is the one you'd need to pay attention to. Let me find the right slide.
Change that chapter, handouts, chapter 14, got to change it to chapter 15. Handouts is chapter 14.
Right. They flipped them in the book. They stuck the investment chapter in there. Okay? So a purchase money mortgage is just owner financing given at the time of purchase. The owner takes back a note for part or all of the purchase price. Just like any other note. Works the same. We don't need to talk about package loans or blanket mortgages or open-ended ones or even construction loans. Just know what a purchase money mortgage is. Okay? Reverse mortgages are exactly what they sound like. In a normal mortgage, you borrow a big lump sum of money and you make monthly payments back to the bank. Put it in reverse. Who's making monthly payments to who? The bank is making monthly payments to the borrower. Put it in reverse. The bank is making monthly payments to the borrower. No. No. So who does this? Elderly people. Why?
Because they don't have enough money to live off of, but they own their house.
Yes. They have equity. But they can't live. They can't eat. They can't put the electricity on. They can't buy their medicine. They have equity, but they don't have cash. So what they do, rather than just going out and borrowing a big lump sum of money, they borrow it in little drips. They get a scheduled monthly payment from the lender. Now keep in mind, obviously that has to end at some point, right? Because at some point you're going to run out of what? Equity. Guess what has to happen at that point? You either better hope you're dead or you got to go. Because at that point in time, they're taking the house and they're selling it. Because you've borrowed all the equity.
What's the term usually on these?
There isn't a term. It's usually up to 75%
So you
loan to
can borrow
value.
the money until you
Hit 75%, then you got to go.
You gotta sell it and get out.
You don't have to sell it. They do it for you. You just got to get out.
Convenient.
Yeah, right. Yeah.
That is really courteous.
Yeah, you don't have to sell it. They do it for you. They take care of it.
If you're 90 years old, it's not a bad deal.
What, right. I mean, so really what a reverse mortgage is a race that you're going to die before you run out of equity in the property, essentially.
It's just not equity, it's more than that. Suppose you spend all your equity, $100,000. Spend it, then they still sell your home?
Yeah, right. As soon as you've hit, they're sending you monthly payments. As soon as you hit the cap, you've got to go.
And your house might be worth $300,000.
Well, your cap is going to be set based on the value of the property. So they're going to let you borrow usually up to 75% of the value of the property. And at that point in time, you're done.
And you still probably get to keep the proceeds from your sale.
If there's any additional.
Right.
Right. If there's any additional. But they cut it off at 75% to make sure they're covered. Okay?
That's what Medicare did.
We already talked about mortgage priority. The only thing we've added here is that the idea that there could be more than one loan. If there's more than one, we pay them in the order that we say them. First mortgage loan gets paid first. The second loan gets paid second. We've already talked about mortgage priority.
What's the longest term you see for a loan?
The longest term, I've seen a 40-year term. 40-year term, yeah.
Is that a very expensive home?
No, it was actually a particular rural loan. The USDA has terms up to 40 years. Yeah, it was. It was for a rural property. Okay. We are going to, on Wednesday, talk about qualifying the borrower. We have not done that yet, but we're going to talk about that on Wednesday. That's the next piece of math. But we use a lot of things to qualify the borrower. The biggest is something called the debt-to-income ratio. The debt-to-income ratio, and that's the math we're going to do on Wednesday to wrap this chapter up, is how to qualify that buyer. How do we know if the buyer can afford that mortgage payment? That's a big question, to make sure that the buyer can afford that mortgage payment. All right? And I'm going to stop right there because then we're going to finish that on Wednesday. All right, guys.